Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, one of the things we've been talking about, we're going to get into this investing thing, but one of the things I want to also offer up to you, if you're not sure about your current asset allocation, if you're a little worried about what's going on with your portfolio in this market, this might be a good time to take get maybe another look at it, all right, get an analysis done. So what I'm going to do for the first 10 callers to my office this morning, the number is 615-376-5325. Tessa's standing by to get your information. She'll send you out a little questionnaire kind of thing, a little thing to fill out and with your information and a checklist of things to bring to your appointment with me. And we'll do up a full comprehensive financial plan for you, and incorporate, of course, with that, means incorporated into it, will be an investment plan, an investment analysis. So we'll take a look at your current holdings. I'll be able to I'm going to print out some Morningstar reports. I'm going to go over those with you in great depth as to your current position, so I can show you not only what your average returns have been over the last 1, 3, 5, 10 years and beyond, but we can also take a look at the standard deviation. This is the measure of volatility. This is the risk measure, if you will, in your portfolio. So it can show you relative to the market how your portfolio is going to perform. So an example would be if we've got a standard deviation in the market of 15% and your portfolio is up around 18%, that means in a period like this when the market's going all over, your portfolio is doing even more movement, more risk or volatility in it. It's gone even having bigger ups and downs. And then we'll show you how you can reduce that volatility down dramatically, cut it in half, in fact, so where if the market, whatever's going on with the market, you're going to be going on a lot smoother channel, if you will, not having these huge ups and these huge downs, but just tracking along at a nice rate of return and minimizing volatility in the process. That's how asset allocation works in a portfolio. So again, if you're one of the first 10 callers to my office this morning, 615-376-5325, that investment analysis, you want to see how you're doing. If this is making you a little nervous and you want to get some, take a look at it and see how you can improve it, how you can reduce volatility and still get the returns you desire and that you need, that's how we're going to do it. And we'll show you your financial future and ways to improve it. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, we're going to jump in. I'm going to get into, one of the things I've talked about, and it's in the book as well, is the 3 worlds of investing. So let me explain what that means. We'll get that slide up there for you. So on the 3 worlds of investing, what I talk about here is this is looking at both safe ways to invest or to place your money, as well as how the markets work a little bit there, how that factors in. So let's just talk about 3 worlds of investing. First one, safety and protection. So these are things like savings, checking, money markets, CDs, savings bonds, treasuries, fixed annuities, and understanding how these work. You get a principal is guaranteed, your interest is guaranteed, penalties for early withdrawal, so you don't take out a 5-year CD or a 5-year fixed annuity if you're going to need the money in 3 years to buy a car, right? Common sense. We know that. Now, what's the problem with this? Now, by the way, if you're not familiar with annuities, I talk about them on the show, and understanding, I'm going to put some perspective here. You hear bad things about annuities, maybe you hear good things, depending on who you're listening to. Here's the real deal. There are about 1,000 different annuity products out there. Out of 1,000 products, there's maybe about 25 or 30 that I would recommend and that I use with clients and such. And why is that? Because we narrow out a bunch of them. Variable annuities is an example, and I'll talk about those in a moment. There goes 800 of them, okay? So we narrow it down to those that are going to give us the best results, and I'll talk more about how that works. But there's the understanding that just as with stocks, how you invest in the market, it's the same thing. You can invest in the market. There are people that are terrified of investing in the market because they've lost so much money in the past and they just don't want to even go there. Well, again, it's how you're invested, though, is a big part of that. Doing it properly, and you can have a much better result than those that maybe got in an improper fashion, and I'll talk more about it. All right, so the safe world, what's the problem? Well, historically, the rates of return are about 1 to 3%. That's not enough to stay ahead of inflation and taxes, which typically are going to run about 3 to 5%. So what's the next way? How do we get ahead of inflation and taxes so that we can protect our purchasing power? See, when we talk about the silent killer, they've said is high blood pressure being the silent killer as far as our health. Well, when it comes to your finances, it's inflation. And this is and taxes have to be considered in this time of year in particular when we're thinking about taxes so much. We're into the tax season. All the more reason for tax planning and understanding tax efficiency when it comes to investing as well. There are ways that you can minimize taxes on your portfolio, and of course when it comes to retirement accounts, how to minimize taxes as well. So inflation and taxes, we've got to earn more. We've got to minimize taxes and then earn enough to stay ahead of what is left with regard to what minimizing those taxes and of course inflation come in. That purchasing power over 10 years, think about this. If you needed $60,000 as an example to maintain your standard of living today, if you look at that with inflation, you're talking about probably close to $80,000 in 10 years, right? From $60,000 to $80,000 just to buy the same things. That's inflation. That's why it's so important that you're invested in such a way that you're earning more, your money is earning more than what inflation basically is taking away from you. All right, now comes the world of, on the far right there, that of potential. All right, so if you look at the far right of your screen, and what we're talking about here is growth, and we're talking about investing in the market. And I've got things like mutual funds, and within your 401ks, your retirement accounts, right? You've got these same things available. Stocks, bonds, individual stocks and bonds, again, mutual funds, exchange-traded funds, and these exchange-traded funds are like mutual funds. Just imagine an S&P 500 index fund as an example. Let's take a look at Vanguard. We'll use that one. So a Vanguard S&P 500 index fund and a Vanguard S&P 500 ETF, exchange-traded fund. These are basically, they own the same things, all right? The difference is how they're traded. The ETF is going to be traded intraday, meaning it trades like a stock, during the day you could sell and buy, whereas a mutual fund is at the end of the day. But other than that, and their performance and the rest, and typically with ETFs, a lot of times you may get lower fees. So REITs are another one, and then again, variable annuities. So I'm going to take a caller, and then we'll come back to this. On the variable annuity side, I definitely want to spend some time with you on that. This is probably one of the riskiest things to invest in, and understanding how that works and the way the fees work and what makes it more risky, we'll get into in just a moment. But first, hi Sherry, how you doing? Good morning.
Yeah, good morning. How are you?
Very good, thanks. How can I help this morning?
So I have a few stocks, and as you know, we're not doing very well right now in the stock market. So I'm wondering what I should do. I want to keep them because they're two potentially good earners once the state blows over. But one of the stocks I've lost like a couple $100 or more. So should I just keep it? Because if I sell, I'm going to lose for $200 to $300.
Right. Yes, this goes what I was talking about earlier. One of the things with regard to investing, individual stocks are going to be riskier. Any number of things can happen. Companies go out of business. We've seen that in extreme examples such as Enron and let's see, Service Merchandise going back some time. We've seen restructuring through bankruptcies, most recently with General Motors, before that Kmart and other companies we've seen. And when that happens, those stocks become worthless, basically. You've lost all your money. And that's where an individual stock is riskier. If I've got a diversified portfolio where I've got 10 or 12,000 or more individual holdings, I'm not worried about one or two companies having a problem. All right. Now, the other part of that, when you're positioned, and this goes to your point about not wanting to sell something and lock in a loss, but how is it going to recover as fast as the other part of that? So you may be staying invested in the market at this point in time, definitely. However, repositioning to better ride out volatility and recover faster from a correction or a bear market, this would be ideally the time to do that. So you can be positioned on your overall portfolio in such a way, as I mentioned with the S&P, that it may take 5 to 7 years if we went into a full bear market, or it could take you a year or more depending on the correction and how you're positioned. So this would be a time to say, well, how can I reduce that volatility so whatever happens, I'm going to recover faster, and yet I'm still not going to sacrifice any returns. I'm still going to be able to benefit just as fully as it may be in a position that doesn't do as well. Okay? So in answer to your question, I would say this is a time to reassess how your, those holdings, and of course the tax implications is another piece of that. But this would be a time to reassess that and see if it's a time to maybe reposition yourself so that you're better positioned going forward in the market. We're not going to be worrying about this periods like this of volatility, okay?
Okay, thank you.
Sure thing. Take care. You know, one of the things that when it comes to investing, again, as we talked about, is understanding how you're invested. It's not about jumping out of the market, it's about repositioning sometimes. I'm going to get into this a little bit more. I've talked about it with regard to mutual funds in the past. The average, according to Dalbar, the average investor gets about 1/3 the return of the market. In other words, the S&P 500 index outperforms by about 3 times, all right, 2.5 to 3 times what the average mutual fund investor gets in terms of their investments. And there are a number of reasons for that. And I'll get into them a little later, but the biggest thing for you to take away is that if that's the case, if the average investor is doing so much poorly, am I right, with regard to these mutual funds, and the S&P 500 index is so much better, well, just doing that alone is going to be an improvement. The difficulty is that that's, again, the volatility. So in either of those two situations, I've got higher volatility. So the next step up is that we want to further diversify. I'm going to have that S&P 500 index in my portfolio. It's in there. All right, but I'm going to have other things as well that smooth out the volatility so that I don't have these big up and downs, and yet I'm still going to get that average return that I'm seeking through the market. So this is how you do asset allocation. This is why the importance of asset allocation. In fact, over 90% of the determinant of what return you're going to get in your portfolio is going to be asset allocation. All right. We didn't get to variable annuities yet. We got to take a break, but when we come back, I'm going to jump right in. I want to talk to you about variable annuities, about the markets, how to use them correctly, okay, again, to get the desired rate of return, the needed rate of return to maintain your standard living and quality of life, all right? That's what it's about. All right, but first we're going to take a break. Join me here. We'll be right back on the Retirement Report.